Good afternoon, or good morning, depends on when you're watching this. It is Wednesday, February the 7th, 2024. I'm Dryden Pence, and this is what we call the so what. What we mean by that is there's a lot of information, there's a lot of things going on, there's things happening in the markets. We're in the first part of the year of 2024, and so it's important to kind of get a feel for what we're doing next. Now, as always, past performance is no guarantee of future returns, so we've got that disclaimer out there. But if you think about where we have been and what has been going on, it's important to kind of have some historical perspective. You can see that big dip on the chart here, and that's COVID, right? Anybody remember COVID? We've talked about that. And everything went sideways at COVID. And then in response to COVID, right? So here's the chart. Remember, in response to COVID, we got tremendous fiscal stimulus, and that created this upward slope of the markets that took us to new highs. And then in inflation, and the Fed started raising interest rates. And that's what took the markets down. And then we bounced around a little bit, and the Fed then kind of began to hit this pause button. I'll show you that in greater detail. And the next thing you know, the market recovers. I'm going to talk through all of these issues several times during this video. So I wanted just to give you the market's reaction to all the things that were going on. This is a frame of reference for what we're talking about. So really you get these questions, right? Soft landing, no landing, recession, what's next, what to do. I'm going to walk you through all of those things and see in the next few minutes where this all stands. Now, here's the important thing to recognize. As I showed you on that first chart, it's really been the three F's. First, we had COVID. That triggered a tremendous fiscal response. We put more money into the economy in 1 year, $5.4 trillion, than we did in all of World War II. When you take that much money and you put it in the economy in response to COVID, that really stimulated everything. And this fiscal stimulus then ignited inflation. And inflation took off. We all remember that. Well, in response to that inflation, the Federal Reserve started raising interest rates. And that's what kind of took the market down, right? And everything became all about the Fed. So first it was all about fiscal stimulus. Then it was all about the Fed. But guess where we are in 2024? We're back into a moment where it becomes all about fundamentals. We've gone through 3 years of massive abnormality in the economy and the markets. And now in 2024, we're able to get back into some sort of normal comparisons and some sort of normal data. We think that's highly positive. Let's talk about how we got here. Remember those 5 Ps I've talked about before. First, we had all the stimulus. Then we had the invasion. That was kind of picked up oil prices dramatically in the invasion of Ukraine. That lit the fire on inflation. That took it off. We peaked in June of 2022 at 9.1. The Fed raises interest rates. They drive it down. They've got a target. The 2024 target is about 2.4. Current's about 2.6. And we've got lots of good progress on inflation. That makes a difference. So then the Fed, after raising interest rates, they decided to pause, right? They've gone a period of time to pause. And then the next move is, when are they going to pivot? When are they going to start lowering? And then we talked about corporate profit growth. This is the thing, and I've mentioned this before, but I want you to pay attention to it. You see, chief financial officers of corporations, they're human too, right? And so they have uncertainty into their predictions and uncertainty in businesses. When the Fed was raising interest rates a whole lot, they had no idea what their cost of capital was going to be. You had no idea how expensive was my money, right? Interest rates are just basically the price of money. And so they had no way of managing their inventories effectively, their inventory cost effectively, their cost of capital, their spread, all of those things. I mean, think about it as an individual. If you have a variable rate mortgage on your home is your biggest, expense every month, and interest rates are rising really, really fast, you have no idea when they're going to stop. So you have no idea what your mortgage payment's going to be. And if you don't know that, are you going to go out and buy a new car or spend a whole bunch? Probably not. So that's where corporate America has been for the last year. So basically, corporate CEOs and CFOs kind of always downplayed their expectations. They downplayed their stuff, and they didn't really know how to maximize their margin because they had no idea. So this uncertainty has worked its way into corporate behavior. But you'll see in a few minutes, what does that mean for us in the stock market? Now, the next thing is, this is an election year. I'm not going to spend any time on that today, but historically, in election years, you end up about 13%. So let's move on. I talked about corporate CFOs, this whole illustration piece. This is why, this is the third quarter, if you take a look at earnings are the biggest derivative of how you get a stock price, right? And you see about 50% of the companies in the S&P 500 in the third quarter, they beat on sales, but 81% beat on earnings. This is very big, consistent earnings beats. Why? Because everybody had lowered expectations because they didn't know cost of capital. They lowered their estimations of their profits. But now they're beginning to understand. Now move this forward into fourth quarter, you can see the same pattern, right? Beating on sales about 53% of companies and beating on earnings about, we're about halfway done, but about 80%. Same type of pattern. And I think what we're going to see over the next couple of quarters, we have a very similar pattern of outsized earning beat because of lowered expectations. Well, what does that really all mean? That means that companies are actually able to outperform, and I'll take you deeper into that later. I want to talk to you a little bit about the wars, because people always are asking me about that. What's the things that can go wrong with our thesis of a pretty good year? Well, you have the war in the Ukraine, and you have the war in Gaza, and you have this tanker situation around the world, right? Here's the thing that's important. When you look at global risk, and big events, right? Like what can go wrong, right? What's interesting is geopolitical risk tends to kind of be surpassed in about 45 days. If you think on average, you have an event, something ugly happens, markets go down, and then about 45 days later on average, they're back to where they were. And so we're going to continue, these wars are going to continue to have moments. There's probably, the stalemate in Ukraine will eventually break, something will happen. The situation in Gaza, because we really didn't have an expansion of that beyond what people were thinking about. Everybody got very, very worried at first. That didn't become a wider conflict. It's still kind of messing around with tanker wars and things like that, but we're beginning to get control of that situation. So all of these things, what I want to say is when you think about 20 and you get massively worried about geopolitical risk, the important thing to know is that generally geopolitical events work themselves out in about 45 days. None of them are the end of the world. Now, here's the next big question. Pause, pivot, no landing, soft landing, hard landing. Well, we think we're in the pause. Sooner or later in 2024, there's going to be a pivot. We think that the economy is basically in the no landing, soft landing world. We don't see a recession. We certainly don't see a hard landing. And we've been in that camp really since February of last year. And I'll talk to you about why. Let's get into where we were with inflation. Remember, this is what happened with inflation. We got up to 9.1 and then it came down. Now we're in that part of fighting inflation where it's hard, right? The first 5, 9 to 3 was kind of easy. Well, 3 to 2 is kind of hard, right? So the easy work's been done. And the fact of the matter is the Fed raised interest rates, brought down inflation, and then you had these series of meetings where they're pausing. Right? Initially, we started to pause, and you only kind of find it in retrospect. But here's what we think is going to go on. We're going to go, really, we started kind of in May or June, and we're going to probably work our way through to probably May. We'll have almost a whole year at 550. And the point of the matter is we're waiting for the economy and all of these heightening that we have and this pause to kind of work its way out to bring down the inflationary pressure. This is the service sector, that purple area. That's the thing to watch. The red area is fuel prices. So this is the thing. Here's your watch out, right? Gasoline prices and fuel prices are the thing that will ignite inflation. They're also the thing that will probably keep it tamped down from a rapid movement. Services take a bit longer to work their way through. So you have to recognize that the sticky part where we are right now are bringing down housing costs, bringing down service costs, lowering the rate of inflation on those sectors that's the hard work. That's the hard work. So let's look at oil prices. Well, we're back down into the low 70s, right? Who would have thought that when you have conflict going on in the Middle East? When you basic average price of a gallon of gas is $3.10 nationwide. Now in California it's a lot more expensive, but the rest of the country, that's what they're dealing with. So why do we think there's not going to be a recession? It's really simple. More people are working, making more money than at any other time in our history. We've added over 4.5 million workers since the peak, right? We got more people working than we had pre-pandemic. And in the last year, we've added like 2.7 million workers. That's like it's like growing the entire state of South Carolina, right? Of all the workers there and adding them to the economy in 1 year. And if you really think about it, when you take the fact that we've increased since the pandemic, since the height, the peak before the pandemic, we've gone down and back up, we've added over $2.5 trillion to the GDP. That's like growing the entire country of Italy in about 2.5 years. And Italy is the 8th largest economy in the world. So when you think about it in those terms, you recognize that this fundamental engine of the American economy that creates jobs and creates wages and creates money for people to spend, because what do Americans do when they have money? They spend it. And so it drives the economy. So you've got more people working, making more money than ever before. And their labor productivity is at almost an all-time high. And we have 1.4 jobs for every person there. I don't see how you can have a recession in that environment. Very, very difficult. So we think the thing to worry about is not necessarily that we have a recession. We may have a little bit of a slowdown, but we're going to kind of chug all the way through this. So that sets 2024 up for a pretty good year. The other thing is inflation expectations have now come down. So you're beginning to come back to some, again, I talk about fundamentals. I talk about returning to more of a normal set of circumstances. Let's talk about that a little bit more. People worry about inflation at 3 to 4%. But I don't think they realize that really this anomaly of inflation at 2% or below 2% really was only something that happened in the previous decade or two. If you go all the way back to 1971, we've lived half of our lives with inflation more than 3%. And we've lived over half our lives with more than a 4% of federal funds rate. So the important thing to recognize is although we had these elevated federal funds rates and we have these elevated inflation rates relative to what it was over the last decade or two, it's really going to be okay. It's really going to be okay. So when we move into 2024, what does that mean for markets? Let's look at 2023. This is the range fan. Now this is pretty, this is what we publish every year. Everybody who follows us knows we publish the range fan and we mark the market through it. And so this is what happened last year, right? And you can see when the prices get above, the S&P 500 gets outside the range fan, it tends to go down, and it goes below the zero line, it tends to go back up. And you can kind of read this like a roadmap and have reasonable expectations for what's going on in the market. That was 2023. Let's look at 2020, and here's the important thing to know too, as I move into 2024, pay attention to this. When you have seasonality, right, normal patterns, when you have a year, remember 2022 was pretty ugly, right? When you have a year where you've gone way down more than 10%, the following year, you're up, right, more than 10% generally, and year 3 after that, you're up somewhere in the neighborhood between 10 and 11%. So this is one reason why we think, if you just look at normal patterns, this is one reason why we think that 2024 is going to stack up to be kind of a high single-digit, low double-digit year. Pretty positive for portfolios. Now, where are we on the range fan right now? As you can see, we had a drawdown right after the first of the year. That's because nobody wanted to sell in fourth quarter because they're going to have to pay a lot of taxes. So they waited till this is how it works. They wait till the new year. They sell because they think things are at a peak. They've moved the tax liability of capital gains from one year into the next. But then, of course, things begin to take off, right? Remember, I talked about profits. And I talked about earnings growth, and I talked about return of fundamentals. And all of a sudden, the market is now up almost back to all-time highs just about. We're approaching 5,000 on the S&P. So here's where we are. We're probably right now, early part of the first quarter, we're probably a little bit ahead of ourselves, which is important to realize, right? So we've kind of jumped through this. We're a little bit ahead of ourselves. There's probably going to be a little bit of a correction, but then the important thing to recognize is, what do I always say? Take advantage of volatility, don't be its victim. So when we think that we're going to see this little bit of a correction come up in the first quarter or second quarter, it's important, if you've got any extra cash laying around, to be ready to deploy that, right? To be ready to deploy that, because you're going to be able to buy some things on bargain. Because overall, we think the year is going to be positive, and with the fundamentals of the economy are going to show it. So here's what we know. The Federal Reserve stops hiking. That's happened. The next move is a pivot. So that basically, if you remember that chart where I talked about interest rates being at 5.5% for a while, we think that's probably going to continue until May or June, and then you get this probably a 1/4 basis point reduction, and we think there's maybe 2 more. So we're in the camp that says maybe there's a total of 3 reductions this year. That's if the economy slows down a little bit. So the important point here is that be prepared for a little volatility in the first quarter, be prepared to take advantage of it. Then make sure we're in a position that we're going into the back half of the year in an environment where we're likely to see 1 or 2 25 basis point interest rate cuts. That too will be a positive sign for the market. So we see a more stable, generally broadening rally. We think that the first part of last year was all about the Magnificent Seven, those tech companies, and then it kind of broadened out. We still think that you're going to have some strong Magnificent Seven play here early on, but we're looking for the broader S&P 500 to really become the engine of growth and positivity in the market all the way through this year, because companies are having margin and profit growth. Remember what I said, they kind of downplayed everything, but now the economy is doing good, and their cost of capital is going down, not up, right? Inflation's going down, not up. So we're in a situation where that's good for companies, and that's good for margin growth. And margin growth and profit margins are the biggest determinant of the stock price. So when we think about what's going on, remember, we study human behavior, we look at things ahead of the change, we look at what's coming down the pike. We actually think that 2024 is going to stack up as a pretty good year. We think it's going to be a positive year. We think there's going to be some volatility getting there, but we also think what's really important is we're finally returning to that moment where fundamentals begin to matter. It's no longer about a bunch of fiscal stimulus. It's no longer dancing on the head of a pin or whatever the Fed decides to do. It's back to what our company's going to do. And American customers and consumers, they spend a lot of money. They're making more money than ever before, and American business is innovative and hardworking, and they know how to make profits. We think 2024 is going to straighten up to be a pretty darn good year. Thank you very much. This is the So What.